Rosso, Professor of Finance at EdHec Risk Institute, who will be speaking on the Amundi survey results. And then we'll have 10 minutes of questions from Mathieu Guignard, Global Head of Product Development and Capital Markets at Amundi as well. But over to you, Ricardo.
Thank you very much. And I have to start with a bit of an apology. In these COVID days, I'm afraid I am in a medical emergency at home, so I am the only one at home. At some point, it might be that the bell will ring and I will have to, 1 second, open a door. Apologies for that. It's not very professional, but there is nothing that can be done. So indeed, we will be talking about the results of a survey, but I would like to put the results in a broader context of fixed income investing and factor investing in times of QE. So this is the outline of the talk. I'm going to present a few selected slides from the investor survey. I wish I could do more, but given the limited time, I've just culled a few. I will just remind myself and everybody of the idea behind factor investing. And the point I will try to make in this presentation is that the signals that normally tell us when it is good to invest, what are the factors behind the different risk attributes, have been completely mixed up by quantitative easing. And I will therefore move to the strategies that no longer work and suggest the strategies that still work with some conclusions. So it is a difficult time for factor investing, particularly in fixed income. There are general reasons for this, which are shared amongst all the asset classes. Everybody's saying it has been a difficult year for factor investing, and there are specific reasons for fixed income. Fixed income has arguably felt this difficulty more severely than other asset classes. And then I will talk, trying to give a bit of an uplifting finale, what still works with some qualifications. So first of all, I remember presenting a similar slide last year, and this slide doesn't change very much. So for a moment, I thought, did they put in the same slide? No, it's not, but it's very similar. Excuse me. Come in, Seba. I want to talk.
Sorry about that, guys. Give us 1 minute.
Many apologies. So I'm back.
There he is.
So 11% of the sample of respondents currently use smart beta. So it is a pretty small percentage. If we look at the same slide in equities, I seem to remember it's about 36%. And of 11%, it is 68% invests less than 20% of their total investment in smart beta and factor investing in fixed income. So it is not a great penetration. And the next obvious question is, why is the penetration so limited? And again, I remember from last year, it is exactly the same top reason. Fixed income factor risk premia are not sufficiently documented in the literature. At EDHEC, we have published some work in this direction, but indeed, as I will be explaining in a few minutes, there are problems with fixed income investing, factor investing in fixed income. And then we have efficient bond benchmark. This touches to a different type of problem, etc., etc. Finally, what is needed? Integration of ESG into smart beta strategies. This is commendable. This is very ambitious. My take on this is that fixed income strategies, beta fixed income strategies, are, let's say, experimental to start with. ESG is rather, let's call it experimental as well at this stage. Combining two experimental things together is, to say the least, challenging. What do I mean when I say that ESG is experimental? Clearly, there has been a great movement into ESG investing, absolutely. Whether it is the case that one can achieve a mantra of doing well while doing good, the jury is still out. And Probably one would have to distinguish E from S from G. I have 20 minutes, so I will not dwell any further on this point. So I can summarize the findings of a survey as 2 cheers for fixed income factor investing. So why are we in a particularly difficult patch? Well, let's remind ourselves for a second of what is the big idea behind factor investing. True factors, not anomalies, not behavioral features, etc. True factors are compensations for the fact that you are getting a good payoff in good states of the world when you don't need the money, and you get bad payoffs in bad states of the world when you would need the money. The most typical example is liquidity. Liquidity is the fair weather friend. When you don't need the money, you get your carry, but when everything breaks loose, when you just need the money, then your liquid security doesn't pay well. So this is a true factor, and exactly because it is a compensation for this bad timing of payoffs, a true factor does not disappear when you discover it. If you discover an anomaly, you can make it disappear because people said, oh, we have been silly. No, there was no reason why yellow bonds should yield more than blue bonds. Let's arbitrage the discrepancy away. If it is a regulatory arbitrage, it can stay there, but it can disappear at the stroke of a regulatory pen. Behavioral features can be stable, but they can always be arbitraged away if there are arbitrageurs, call them hedge funds, with sufficiently large shoulders to take on the trades. In true factors, instead, are relatively stable. And how does the true factor translate into risk premium and into prices? Exactly because I don't like a security, which is a good weather friend. I will not pay much for it. The price goes down and the yield goes up. As the yield goes up, that extra yield is my risk factor. So true factor investing 101 is constructing portfolios with optimal exposure and diversification to true factors. So from factors to prices, prices should reflect expectations of future cash flows, discounted in a way as to take their state dependence into account. State dependence means paying well in good conditions and pay badly in bad conditions. The next step in factor investing is to ask oneself, can I tell whether the compensation for risk today is high or low? Can I link the state-dependent risk compensation to yield curve or macrofinancial variables? In the old days, the slope of the yield curve used to be the classic indication for it is good to be long my duration risk factor. I will have a lot to say about how all these signals have been corrupted. Enters quantitative easing. Now, let me make super clear. I'm not saying for a second that I had a better idea than quantitative easing. Perhaps quantitative easing, there was nothing else that could be done given the financial, monetary, real economy conditions. I'm not a central banker. That is not the point. However, from the point of view of factors, it has been a disaster. QE, to begin with, has become a one-way street. Every time there is a crisis, there is an easing, and since conventional monetary policy is no longer effective, operated at the short end of the yield curve, we have gone to the long end of the yield curve and to a variety of asset classes. In what we used to teach our students, and perhaps we still teach it, is that when it comes to financial assets, supply and demand should not matter and should be fundamentals, because if it's out of sync, there should be the arbitrageur that brings it back in line. But in reality, with QE, the player is a central bank who can print money, and therefore supply and demand does matter, which means that with pervasive QE, the price signals about the expectation of future cash flows, about the magnitude, and even the sign of risk premium are totally corrupted. Let me make a couple of examples here if examples are needed. This doesn't include the last gyrations of the S&P after the American elections, but this is a snapshot of the S&P 500 taken from before we knew how to spell the word COVID, through the March swoon and back to a couple of weeks ago. So if we look at the level of the S&P 500, it is basically the same as pre-COVID. Now, if you think for a second, are my expectation of cash flows as good as they were in December 2019? Well, certainly not. We have an economy, worldwide economy, that if not on its knees, is definitely in difficulty. What about the risk premium? Shouldn't risk aversion have increased? Arguably, there is a lot more uncertainty now than there was in December 2019. The only way to make sense of the level of the S&P 500 here is through the lens of S&P 500. Rationally discounted expectations are out of the window. And probably you're familiar with this type of graphs. This is the Federal Reserve's balance sheet, which was already quite substantial. And this is the spike that has occurred in March 2020. We all know what has happened. And in the case of the UK, Bank of England at the moment is holding 44% of all the gilts in issuance. It gives you an idea of a type of distortion this implies. Again, these are the purchases of Treasury by the Federal Reserve, and we know what happened in March. We know the Treasuries were no longer the place to go, the flight to safety, and there was actually a drive for cash, and there were wild movements in the yield curve and in the 10-year Treasury that behaved completely differently from how it behaved in 2008, and therefore the Fed stepped in by readjusting the yield curve as the Fed wanted. And these are the interventions in March, week by week, 16th, 23rd, 30th of March, etc., etc. And these are, again, mixed up signals. These are the 10-year, the 5-year, and 2-year. This is the cash future basis, the difference between the actual and the implied repo rate. We all know it went completely haywire, and the Fed had to act as a provider of liquidity of last resort. So if the level of yields cannot be reconciled with expectations and risk premium, the only way that I can look at treasuries is as a hedging instrument, the Greenspan put extended forever. So the Greenspan put is the idea that when some bad things happen that hit my equity portfolio, treasuries will bail me out. And actually in March, this wasn't really working properly. Normally, there is a natural flow into the treasuries by investors, which have learned this knee-jerk reaction. In March, it didn't happen, and it had to be forced by QE. The compensation for assuming duration factor risk, which is the main factor in fixed income, is at the mercy of QE. So it is not the determinant of whether a strategy is going to be successful or not, is whether the central banks will intervene in QE as robustly as the market expects or doesn't. Shape of the yield curve contains very little information, contains no information, because the shape of the yield curve is determined by QE. The slope signal has almost been reversed. Why is that? Because in the old days, during a crisis, I would have a cut-off rate of the short end that would steepen the yield curve. Today, the short end of the yield curve is virtually at zero. Therefore, in a crisis, I have QE that purchases assets at the long end and therefore lowers yield at the long end, flattening, not steepening the curve. Inflation indicators, which underpin the Sisler-Powell factor, which used to be very successful, are indicators of deviation from rational prices, for the same reasons, are ineffectual. So, in pure factor investing terms, what does still work? I make a distinction here between long-only strategies, long or short strategies. So at every point in time, you're either long or short, but not long and short at the same time. And finally, long and short strategies at the same time. Bottom line, momentum strategies pure long only at the moment do not work very well. Momentum strategies, as you can see from these graphs here, they, yes, kind of work, and you can look at the details. Tom is telling me I'm coming towards the end of my talk, so I'm going a bit more quickly here. There are relative value strategies in treasuries, and again, we have published in this direction, and there are some interesting opportunities of exploiting deviations. But, and this is, Tom, you can relax, this is my last slide, the periods where the profitability is highest, you see in this past historical graph, it is in 2008, etc., are the periods of highest illiquidity. This is the graph of the Treasury VIX and the measure noises liquidity by Hu and Pan. Therefore, exactly when the discrepancies is there, it becomes very costly to exploit them. So this brings me to the end of my presentation, and the end of my presentation simply tries to convey to explain why at the moment, straight, good, solid factor investing is in a particularly difficult time. There is lots more to be said there. Please ask me questions, and I'll do my best to answer them.
Great stuff, Ricardo. If we could just bring in Mathieu here. Mathieu, it'd be fantastic to get your reaction to that and what your key takeaways were.
Well, I think definitely this has been a hot topic for some time now to associate fixed income and smart beta. Definitely, as Ricardo stated, this was not the good year for that, but sure, it will come. We've heard a lot about it, and every time we talk to clients about equity, smart beta, the question was raised, what about fixed income? So for sure it will come. Definitely this year in the European ETF market has been a fixed income year. Whatever strategy we talk about, over half of the flows were in fixed income compared to equity. So this is very unusual and very specific to this year. What was very interesting as a very general comment is that before the crisis, regulators have been questioning whether ETF could be a threat to the financial system. And after this crisis, some regulators have stated that ETFs may have been a solution in the crisis, especially by maintaining liquidity for clients, thanks to their pricing adjustment mechanisms that can reflect the actual conditions of liquidity and the actual cost of liquidity. ETFs were sometimes the last instrument available for price discovery and for providing liquidity to clients. And definitely the purchase program by the Fed of including ETFs is I think a clear sign of that recognition of ETF being now a very central and solid instrument in the financial market for fixed income specifically.
Sorry.
No, maybe the other conclusion of this day was about ESG, which I think is the very important theme this year, of course in the equity area, but also in the fixed income area. We don't have any client meeting today occurring without talking about ESG, which is definitely the very hot topic. Be it for regulatory reasons, pushing clients towards ESG, but also I would say for ethical or philosophical reasons, also joining those regulatory reasons. And in the end, also some good performance reasons as well, with, of course, flows pushing performance and pushing overperformance of ESG strategies compared to more vanilla strategies. But also, and this is mainly true for fixed income ETFs, structural reasons about the risk profile of portfolios, in which you can consider that ESG is a good way to improve the risk profile of a portfolio by limiting some of the governance or environmental risks that are embedded in that portfolio.
Mm. And what are the other kind of benefits of combining ESG and fixed income? Apart from that sort of risk profile, are there any other areas?
Well, definitely the as I mentioned, the three reasons why investors choose ESG today are the regulatory reasons, which definitely drives the demand, but also managing the risks in the portfolio. We see that the retail demand is also now joining the more institutional demand that was originally driving the market. This will maybe shift a little bit the offer and the demand towards more thematic approaches of ESG by splitting the three pillars of ESG. Definitely in Europe, the environmental pillar is the most popular. I think the two others will come later as well.
Yeah. And Ricardo, just giving you the last word here, what conditions are needed for factors to make a comeback then after such a dismal year?
Yeah, it would be a beautiful condition. It's simply QE is no longer necessary because we are going back to normality. That looks further and further away. And unfortunately, there has been this ingrained, perhaps there was no alternative, but there's been this ingrained policy that every crisis has to bring about a bout of monetary easing. And unfortunately, crises are asymmetric. That is very, very, very rare to have an incredibly positive surprise. And therefore, this creates a ratchet. And I do not see in the immediate future where we're going to exit. Once we have exited, once prices still reflect the investors' opinions about expected cash flows and risk premia, then factor investing is back. And I am a strong believer of factor investing. I think that in the very end is what makes sense of all of this. At the moment, for good and strong reasons, there are emergency issues that cloud the picture.
Great stuff, guys. Well, I just realized we are running over slightly. But I will say thank you very much for jumping on. Much appreciated for a bit of your insight there.
Thank you. Thank you very much. Bye.
And that just about concludes the day then. So yeah, just a massive thank you for attending. The on-demand sessions will be live. So if you want to watch anything back, then they will be live on our website over the next couple of days. So keep your eyes out for those. I'd also like to say a massive thank you to our sponsors, CraneShare, TradeWeb, Franklin Templeton, Tabula, Amundi, and Ultimus, our academic partner, EdHec Risk Institute, and our supporter, Jobs and ETFs. A couple of pointers from us. We've got a GHCO, as I mentioned earlier, GHCO webinar coming up on the myths around ETF liquidity. That's on the 18th of November, links in the chat on the right-hand side. And also we've got our big two-day, big cool event on ESG, and that's on the 25th and 26th. We're really excited for that. We've already got a cracking speaker lineup. So I'd make sure you tune in for that. But otherwise, yeah, just stay up to date with all the goings on in the ETF industry on our website and all our other things. But yeah, thanks a lot, guys.